Hello, welcome to the MoneyBytes podcast, brought to you by Quiver Finance Inc. My name is Lulu, and today we'll be talking about bank runs. What are bank runs? It's a very interesting topic, right? There's been a lot of collapse in the financial services sector over the past 6 months, starting from FTX, and then we had a whole lot of ripple effects from that. That started in the crypto sector, and then this year we've had collapse, or rather in the traditional finance system with banks like Silicon Valley Bank, Silvergate Bank, Credit Suisse, and the likes. And I know there's been a lot of questions that people have been asking me personally, that they want to understand what this means and how can they protect themselves from this kind of similar situations coming up in future, or whenever this might happen again. Before we go ahead, remember to like, subscribe, and share this with your friends. What are bank runs? Right. I mean, for a lot of people, especially the younger generation, probably didn't experience the 2008 financial crisis. So a lot of people have never heard of the term bank runs before, except maybe you're studying economics or you work in finance. A lot of people do not know what that means. But it's a very simple analogy, or a very simple situation to understand. Right. A bank run occurs when a large number of depositors in a bank withdraw their money from the bank. So basically, if everybody in Access Bank wakes up one morning, or everyone who owns an account in any traditional bank, like maybe, I don't want to mention names, right, wakes up one morning and says, you know what, we want to withdraw all our money from the bank, would the bank be able to pay back, right? So I know a lot of people might have thought of this scenario happening and be thinking it's something that could never happen. But it has happened in the past, and it actually happens more frequently than people realize. Since 2010 up to date, there has been about 550 bank runs, not bank runs basically, but bank collapses, right? With especially in the US market, right? There have been about 550 bank collapses over the past 8 to 10 years, and it's something that happens quite frequently. And there are actually systems in place, right, to protect depositors from losing all their money when a bank collapses. So, what could trigger a bank to collapse? These are things that we'll be discussing in as we go ahead. So today, let's take the issue of FTX first of all. FTX collapsed as a result of commingling of funds, and what does that mean? Commingling of funds happen when you're mixing your business's money with your own, right? So you're taking deposits from your corporate account and using it for personal expenses, or you're taking money from your personal account and using it for business expenses. Maybe you're using your personal credit card or your personal debit card to fund business transactions and all of that. It happens a lot, more than people realize, and it's actually dangerous for businesses, especially when you commingle funds without proper documentation. And that's the major problem that led to FTX's collapse. In FTX's case, right, they lent out a lot of their depositors' money, deposits that they held. Remember, FTX is a crypto exchange, right? So they held users' deposits, and then they lent it out to their partner firm, which is called Alameda Research, right? So they lent the money out to their partner firm, who then went ahead to use that money for trading. There are a lot of risk involved in trading, like we all know, and Alameda Research took that money and used it to trade, and they lost the money. So when it came for the time when FTX had to recall the loan, the Alameda Research couldn't repay the loan, and that ultimately led to their collapse, right? So they had a huge hole in their balance sheets, which they couldn't fill. So you may ask, how come FTX was allowed to lend out securities, basically, that is their users' deposits, which are not just money, but they were actually cryptocurrencies, which can be considered as a class of securities, although it depends on how you look at it. But they lent it out to Alameda Research, which they weren't supposed to do. But, I mean, they did it because there was very little regulatory oversight. And this led to the collapse of FTX as we know it, and the whole ripple effect that it had across the industry, right? People lost their jobs. A lot of other cryptocurrency companies and startups who had their funds in FTX also lost months of runway. Some of them actually collapsed as well. And it led to some, even venture capital funds also collapsed, because when FTX collapsed, right, FTX's token which was called FTT, which was held by a lot of venture capital firms and a lot of other investors, basically collapsed as well, which meant a lot of people lost a lot of money. I think the total fallout from the FTX collapse was around 20 billion to 40 billion dollars, right? And that was a huge deal in the crypto industry, and people felt like it was going to collapse the whole industry. But it's a testament to the resilience of cryptocurrencies, and we will discuss more about that as we go ahead in this discussion, right? So that was how FTX collapsed, and this led to a lot of questions about the fragility or the strength of the crypto space in general. But the funny thing is, FTX's collapse actually was siloed within the particular ecosystem that FTX itself runs, right? So the people that are mostly affected by FTX's collapse were FTX's depositors, FTX's investors, and also FTX's lenders, right? So those were the people that are mostly affected by FTX's collapse. There wasn't really a massive ripple effect that affected maybe the stability of cryptocurrencies like Bitcoin or Ethereum or Matic, for instance, right? It didn't really have that kind of ripple effect on all those other platforms, right? So we're going to compare FTX's collapse with the collapse of other traditional finance institutions like Silicon Valley Bank, Silvergate, and Credit Suisse as well. So, how did Silicon Valley Bank collapse? Right. So, Silicon Valley Bank was shut down on the 10th of March because they had a bank run. Like I explained earlier on, a bank run is when all the depositors in a particular bank or financial institution request for their deposits at the same time, right? So they couldn't meet the withdrawals, right, at that point in time, and the bank had to be shut down by the FDIC. The FDIC is the Federal Deposit Insurance Commission, which is a federal parastatal. The Nigerian equivalent of that is the NDIC, which is the Nigerian Deposit Insurance Commission, which regulates the financial services sector to make sure that every depositor who has deposits in a bank is insured to a tune of $250,000 in the US, and I think 250,000 naira in Nigeria. So if you have money in a bank and you have about 250,000 naira, you're safe, right? But if you have above that, you need to actually start thinking of other means and methods to actually insure your money in case of a bank run or a bank collapse, right? So Silicon Valley Bank collapsed as a result of a bank run. But what led to the bank run? Like I explained, in FTX's case, they lent out their depositors' funds to their sister company called Alameda Research. In Silicon Valley Bank's case, right, they took their depositors' funds, right, and invested in mortgage-backed securities, which, I mean, if you know about the 2008 financial crisis, you'd be you probably have you probably be a bit jittery when you hear something like a mortgage-backed security. But funny enough, as at the time Silicon Valley Bank invested in the mortgage-backed securities, they were actually safe at that time because the interest rates were around 1.5%, which wasn't ridiculous, and they felt like it was a safe bet because they needed to be able to return interest to their customers as well as make money. That's basically the way banks make money. They take deposits and then they take deposits and then they lend it out or they invest it and take returns on those investments, right? This is what is called reserved banking, right? So the US banking system is a reserved banking system. The same thing with the Nigerian banking system. So basically what a reserved banking system means is that banks can actually take a percentage of their users' deposits, right? And then use it for business transactions, for loans, for investments, and all of that, so that they can be able to turn profit and then also be able to return some interest to their users as well, or their customers rather. So there was nothing untoward about Silicon Valley Bank taking their users or their customers' deposits and using it to invest in mortgage-backed securities. But the problem was they didn't bank or they didn't expect that the boom of the 2020 COVID-19 boom, where we had a lot of boom in the tech sector. Remember, Silicon Valley Bank, like the name intends, is a bank for mostly Silicon Valley startups, Silicon Valley investors, VCs, and residents basically, or mostly tech oriented people who have accounts there. So most of the deposits in Silicon Valley Bank were deposits that belong to corporate institutions, mostly startups, right? And most of those deposits were above the threshold that I mentioned earlier, which is $250,000. So this was a significant bottleneck for the startup economy, because I think Y Combinator came out and said about 10,000 of their startups or startups affiliated with them had accounts in Silicon Valley Bank, which meant that if nothing was done to rescue Silicon Valley Bank, all those companies would have actually collapsed and a lot of people would have lost their jobs. And that's one of the major ripple effects that was supposed to be a fallout of Silicon Valley Bank collapse. So going back to what I was saying in terms of they took their users' money and then invested it in mortgage banks backed securities. Like I said, it wasn't really a bad idea. It was what every other seasoned banker would do, because I mean it's a long-term investment that they didn't expect to decrease in value at the rate at which it decreased. So what I was saying, like I said, was that they weren't banking on the US government, the Federal Reserve, increasing interest rates. So what does that mean by increasing interest rates? Basically, when there is an inflation in the economy, right, one of the ways to combat inflation is to increase interest rates. Because when you increase interest rates, it means that you are mopping up cash within the economy. Because when you have facilities that offer you higher interest, it means that it will encourage people to save more and spend less, right? So you have things like treasury bills or government bonds that offer high interest rates. A lot of people would rather save their money rather than spend, because they know that they're getting more returns on it when they save, right? So this isn't really a bad thing too, as I said. But when you have rising interest rates versus mortgage-backed securities that are long-term investments that have been tied down or locked in for a particular interest rate, right? Which as at the time they did it was about 1.5%, when Silicon Valley Bank invested in the mortgage-backed securities was about 1.5%. And then interest rates were increased to about 5%, which meant that the mortgage-backed securities that Silicon Valley Bank held was worthless overnight, right? And people started selling off those MBSs, and it meant that the value at which SVB bought mortgage-backed securities crashed exponentially, and they were losing a lot of money. So they announced that they were going to withdraw their position from the mortgage-backed security to cut their losses, basically. And people saw this as an indication that something was wrong with the bank. This wasn't them withdrawing from the MBS mortgage-backed securities investment wasn't really a bad idea as well, right? On paper, because I mean they had to cut their losses at some point, but it sent a bad signal. I think they didn't handle the PR around that incident well. So it sent a bad signal to a lot of their depositors, because the depositors felt like there was imminent risk that the bank was going to collapse because of that. But the bank's exposure, at least on paper, wasn't that high. To the bank exposure to the mortgage-backed securities wasn't that high, that it wasn't really threatening their collapse. But because, unfortunately, outsiders, depositors mostly, the customers were not privy to this information. They felt like a bank collapse was imminent, and then it triggered a bank run and people rushed and started withdrawing their money. Right. So going back to reserve banking, just for you to understand how reserve banking protects from bank runs as well, besides the deposit insurance. In reserve banking, banks are expected to hold a certain percentage of customers' deposits. So this deposits is usually at a ratio of how much they expect that their customers will withdraw over a certain period of time. So say you are holding $100 billion of customer deposits, right? And you expect that, okay, every month the average withdrawal rate is $10 billion. Okay, we can have $20 billion in cash to able to manage withdrawals. So for companies that want to manage payroll, for people that want to pay their mortgages or whatever people need money for, you should have at least enough money to support them to withdraw for about a month, about 60 days. So they couldn't meet the demand for the withdrawals, and that was why FDIC actually had to shut them down. So you can see the similarities between the SVB collapse, that's Silicon Valley Bank collapse, and FTX collapse. They were both triggered by bank runs, which was as a result of information that got out into the public space about how their balance sheet or their finances were performing. So yeah, let's talk about the similarities between the two collapses, that's FTX and Silicon Valley Bank, right? When FTX collapsed, there were a lot of people that were saying, it's impossible for traditional finance institution to collapse the way FTX collapsed, in the sense that they felt like it was going to be improbable. Like FTX collapsed in a matter of days, like in 2 days, FTX was gone. But when Silicon Valley Bank collapsed as well, and Signature Bank, I think they also collapsed in a matter of 2 days or 2 to 3 days as well. So the speed of collapse is one thing that they shared. And that just bears testament to the enabled digital world that we currently live in the sense that transactions are happening online now. This is fintech, like I've explained or I've talked about in our past podcast episodes, right? So transactions happen online now, and within the blink of an eye, I think people withdrew about $5 billion from FTX in a day. I think Valley Bank, I think people withdrew about $20 billion as well in a day. That's a lot. Financial services has evolved to a digital level where transactions as bulky as that can actually happen in a matter of days or minutes, right? So that's one of the major similarities between the two collapses. Another similarity between the two collapses, like I said, is they're both essentially bank runs, right? Even though they happen with two different financial institutions in two different aspects of finance, right? In crypto and in traditional finance, they are both bank runs, and they were as a result of both institutions lending out securities, basically. I mean, FTX lent out their customers securities, even though they were not regulated to do that, right? They didn't have a banking license. They were not meant to do that, but they did that. And SVB, which had a banking license, did the same thing as well, right? So they were both bank runs that were triggered by financial institutions lending out deposits and not being able to recoup the value of the deposits that they lent out. Another similarity between both of them is that they are both centralized institutions as well. FTX, even though it's a crypto exchange, is very, very centralized, right? And it's part of what we've been talking about in terms of centralization and how even though there are businesses or there are institutions in crypto which is supposed to be completely decentralized that are actually only decentralized in name only, right? They're not actually decentralized in their operations or in how they service their customers, right? So in a situation where FTX was actually properly decentralized, they were not supposed to have access to users' deposits, one. They were not supposed to lend out users' deposits, two. So these are actually failures or of FTX to adhere to the ethos of decentralization. SVB, on the other hand, is not meant to be decentralized anyway. It's a traditional finance institution, so they don't have any responsibility of decentralization, unlike FTX, which claims to be working in a decentralized finance space, but they are not actually decentralized. They are decentralized in name only. Then, for consumers, we always like to advise users basically to watch out for companies that are actually decentralized in name only. I think, in fact, that will be our next podcast episode so that we can actually show you signs of how you can identify crypto financial institutions that are actually not properly decentralized and how you can avoid them and protect yourselves against them. Right. Also, another similarity between Silicon Valley Bank and FTX's collapse is that they both had ripple effects, right? So now, the ripple effects of FTX, like I said, was contained within institutions that FTX owed money, right? That FTX were their debtors or lenders as well. So those were the people that were affected by FTX's collapse, right? And the fun thing about FTX's collapse again is that even though FTX was indebted to a lot of decentralized finance platforms, right? They paid off those debts first before they collapsed. So, as at the time that they were collapsing, and because decentralized finance basically is governed by smart contracts, right? And as at the time FTX was collapsing, the smart contracts triggered and liquidated all their positions for all their outstanding debts, and those institutions were saved. They didn't experience any contagion or ripple effect of FTX's collapse. While for Silicon Valley Bank, you can't say the same, right? The Federal Reserve Bank and FDIC had to actually come in, right, to let depositors within the bank know that their money will be safe, even above the minimum deposits, right? That the insured amounts rather. So, like I said, FDIC insures deposits for $250,000. So if you have $1 million in your bank account, you're not insured. Basically, that's what it means. Unless you have a special arrangement with some other banks. Some other banks offer up to $6 million of insurance. Like the bank we use, Aquiver Finance, actually does that, right? And for most depositors, they do not have access to deposit insurance above $250,000. So because of the ripple effects of startups that are going to be affected, jobs that are going to be lost, also contagion to other financial institutions as well within the traditional finance space, the Federal Reserve had to come in and actually extend a line of credit to other banks that may be suffering from the same symptoms that led to SVB's collapse. Like I said, SVB invested in mortgage-backed securities, which isn't anything wrong and is not something outside the the jurisdiction of what they were supposed to do, right? So if we can assume that SVB did that, we can also assume that a lot of other banks might have actually done the same thing as well. So to avoid a ripple effect and a contagion basically of other financial institutions being affected by SVB's collapse, the US government had to actually roll out a line of credits to other banks and to say that, you know what, we got your back. So in case you are suffering from the same thing, we can actually provide you with a line of credit that will allow you to stay operational until you can, weather the storm. So, but unfortunately for cryptocurrencies, there's nothing like a Federal Reserve Bank that's going to sweep in, at any point in time to save your deposits, right? So, although there are some DeFi platforms that are actually springing up that are actually offering deposit insurance in a kind of way, right? But it's still a niche aspect of cryptocurrencies, and it's not mature enough for instances like the FTX collapse, for instance, or the lunar collapse of early last year, right? So these are the major similarities between the two collapses. So how can does this really, so now like it kind of sounds like, so where do you want to turn to, right? You have cryptocurrencies, right? Bitcoin specifically was founded in 2008 as an aftermath of the financial crisis, right, of 2008 actually. So if Bitcoin that was founded, right, cryptocurrencies that was started as an aftermath or as a response to the financial crisis could actually have similar crises like traditional finance, what then is the way out, right? And it begs the question: is this the end of the road for crypto? I don't think so, really. It's not the end of the road because there are a lot of, like I said, in our next episode we'll be talking about how to identify institutions in the crypto space that are actually decentralized in name only and not fully decentralized. So one of the ways, just to give you a snippet into what we'll be talking about in the next episode, is one of the ways that a financial institution in the crypto space is decentralized in name only is if your deposits are not yours, right? So if you have deposits in a centralized organization, right, where you do not have your actual private keys, right, to your wallet where your assets are, you don't actually own those deposits. What you have is basically like an agreement that you've lent out your money to these financial institutions, even though you didn't agree to lend out your money. But essentially, you are not protected under any regulations. When you deal with those kind of organizations, remember, crypto is still a nascent industry and there's push for regulations, but currently there are no regulations. Yeah, so in conclusion, that's all about bank runs, basically financial collapse, right, of both traditional and cryptocurrency institutions, right? So there's a lot to learn from this incidences, right? You have to know what institutions you're actually banking with, if it's with a bank or crypto platforms or exchanges that you keep your assets on, right? So our next episode will be about that, and yeah, we look forward to seeing you guys next. So don't forget to like, subscribe, and also comment as well. I want to hear about what you think about this, if this has been impactful for you. Thank you. Have a great day.